Welcome to the Daybreak Asia podcast. I'm Doug Krisner. On Monday, we got Wall Street's first reaction to President-elect Trump's nomination of Scott Bessent as U.S. Treasury Secretary. In a moment, we'll get reaction from Ross Mayfield of Baird Private Wealth Management, as well as Tom Bruce of Tanglewood Total Wealth Management. But first, a focus on the day's top story. Tonight, in a post on Truth Social, the president-elect announced a new additional tariff of 10% on all Chinese goods coming into the United States. Joining us now is Helen, Managing Director and CIO at NF Trinity. She joins us from our studios in Hong Kong. A lot of this seems tied, Helen, to what Trump has been saying about the influx of illegal drugs into the U.S. from China. What's your reaction to this?
Well, look, this fentanyl issue has been widely discussed already, right? Biden has discussed it with Xi a couple years ago. Trump has discussed it. Supposedly, there has been some commitments, et cetera. But obviously, Trump wants to use this as a way to expedite the process. We take a look at the rough numbers in terms of exports to the U.S. It's around $500 billion US dollars per year. And the tariffs being paid is around $100 billion. But that $100 billion is not on the entire $500 billion. It's probably on around $300 billion because there's $200 billion of consumer goods that are exempt. Right. So that's roughly around 30% on the $300 billion. If you increase that 30% to 40%, you squeeze out maybe an incremental $30 billion of tariff payment from China to the U.S. So that number in itself is not a huge or, incredibly meaningful number that's going to make a huge difference to anybody. But I think this is a negotiating tactic to show his strength and to, kick off the trade war related pressures that he's looking to kind of play up over the coming months, if not quarters.
So if this is the beginning of a negotiation, what can we expect from Beijing? What will China do to kind of retaliate?
I think China will certainly make comments, as they have before, about wanting to assist in the fentanyl improvements, et cetera. I think that China wants to undertake further negotiations with the U.S., but as it has with other trade partners over time. But I'm not sure necessarily that it's all going to be about economics only. I'm sure the negotiations are going to spread more widely over other factors, including, geopolitical issues around the wars, including, social issues. And I think it'll be a basket of topics that the two sides take into consideration in negotiation.
So one of the things that we saw in the price action today in the U.S. was this expression of satisfaction, maybe I can put it that way, with President-elect Trump's choice of Scott Bessent to run the U.S. Treasury. He's called for a gradual approach when it comes to implementing some of these trade restrictions. Maybe he's open to negotiating the exact size of tariffs in a way that may be something that Wall Street sees as being a little bit more reasonable right now. How do you assess the appointment of Scott Bessent?
Well, I think the market certainly considers him to be a little bit more dovish and rational and less extreme versus some of the other, prior appointments. But I think at the end of the day, in this administration, people realize that Trump is in the driver's seat and he's the one who's going to want to call the shots. I think that's going to be the prevailing theme. But certainly, at the end of the day, I think everybody in the administration, especially in a position of economic importance, understands enough that global trade is quite important, that actually if you impose all these tariffs, not only on China, but the rest of the world, the impact in terms of global growth is actually very detrimental and could be a lot more detrimental on other countries that are U.S. allies versus even on China, right? So because, exports to the U.S. specifically for China are not as big as exports to the U.S. may be for countries like Mexico and elsewhere, in Europe or Asia, some other countries.
Technology is clearly a focus when it comes to the U.S.-China relationship. I was struck by this report yesterday, I think it was in the FT, that Huawei is poised to launch its first flagship smartphone with a fully homegrown operating system. And this seems to suggest, at least in the view of the FT, that anything that the U.S. has tried to do in terms of sanctions to hold Huawei back is not really working well. And I'm wondering, from your point of view, we've talked a little bit in the past about the export controls that the Biden administration has put on certain technology to China. How has China responded to this in a way that's positive? Is it kind of spurred innovation in a meaningful way?
I think it certainly spurred innovation in many areas. So China has tried to become much more self-sufficient in terms of technology and products. And I think Huawei is actually one of the companies that have done a phenomenal job on that. So if you look at what Huawei is selling globally, not only to emerging markets in China, but to developed markets, it's very sophisticated. It's very competitive and comparable to Ericsson and, all the foreign players, and, more cost efficient and good value for money as well. So that's one front where China has really nurtured the national champions onto the global stage. There are other areas, however, where China, is still lagging far behind and might fall further behind with some of the chip sanctions, et cetera. So I think the gap may not necessarily narrow, especially given the recent years with the additional aggression. And in many cases, China can produce something, but they're lacking one critical component, and that component makes a lot of difference. So that's going to be a challenge for China to try to catch up. And it's not something that you can resolve just by putting more R&D into it, for sure. So we'll have to see how that comes along.
We know the economy on the mainland is sluggish. I think it was yesterday that the Economic Information Daily reported that a new round of consumption vouchers has been issued across the country as a way of trying to stimulate domestic demand, maybe boost a little bit of confidence as well. What do you think it's going to take to get people, the consumer in China, to be a little bit more engaged with the economy?
I think it's not about consumption vouchers, which can only, help a little bit in the short term. I think it's really about confidence in the broader economy and in the housing market, because it's really about wealth effect, right? The U.S. is on this adrenaline-fueled positive wealth effect with the markets going up, property prices going up, everybody feeling richer, everybody hiring, everybody's wages going up, et cetera, and therefore somewhat offsetting the inflationary impulses. In China, it's the opposite. People feel like property prices might come down, and, the economy's outlook is unclear. So the most important thing is the property price in China. That's like 2/3 of everybody's household wealth. So it's not about the short term, a couple thousand RMB of consumption voucher. It's about the government's ability and desire to stabilize the expectation on property prices. If that can happen, then I think the consumption will gradually start to normalize, especially if the sentiment overhang of the tariffs gradually gets alleviated in 2025.
Are you avoiding the Chinese market right now in favor of, let's say, the U.S.?
I think the positives on the U.S. are well understood and already priced in quite a lot. And U.S. and China are at polar opposites. In the short term, the dollar is already very strong. The equity market is very high. Corporate profits are at peak. Multiples are at peak. Positioning's at peak. It might last a while still because people think that Trump is going to do great things for the economy, and you have a lot of structural reforms, unconventional ones even, like this Dodge commission that he set up totally out of the blue. So I think that lasts in the short term, but how much upside is there further off this very high base of expectations, I think is unclear. I think the first derivative of financials and big tech and so on has already performed, and the DXY and the dollar, et cetera. I think there could be a second derivative next wave in terms of the industrial cycle picking up, in terms of some tech companies, if consumer sentiment on laptops and phones starts to pick up, maybe small caps if M&A resumes because of less regulation. That could be the incremental beneficiary. It won't move the index as much, though. On the China front, it's the total polar opposite. Everything is completely dead. The positioning is super low. The corporate profits are at a trough. The multiples are at a trough. The positioning is at the trough. The RMB expectation is at a trough. So I think the key critical factor is not whether the government wants to support the domestic economy. It's actually whether this tariff overhang gets somewhat lifted or resolved in 2025. If that happens, I think China could have much more upside than the U.S., but it might be a while before we find out, and it's kind of a little bit binary in the short term.
Are you seeing market opportunities in other places across the APAC region, whether it's Taiwan, whether it's Vietnam, whether it's South Korea, Japan? Talk to me about what you're seeing in your neck of the woods.
Yeah, pretty much everything outside of the U.S., especially in APAC and emerging markets, has been hit pretty hard as the dollar has hit, historical, multi-decade peaks, right? So there are plenty of companies that have businesses around the world that are either exporters that people are worried about the tariff threat, not just to China, but globally, or they're worried about the currency depreciation when the profits and revenues are booked back into dollars. So you see, let's say consumers consumer staples companies like beer and liquors and so on. Maybe the demand on the volume side is totally fine, but the sales are getting translated back from Latin America or from Southeast Asia back to US dollar, and therefore you have a lot of FX losses and earnings are not growing as well. So I think those would be interesting companies where the core fundamentals are not that cyclical and not that sensitive, but it's right now just being compressed because of these currency fluctuations.
Helen, thank you so much for joining us, chatting about what you're seeing in markets these days. Helen Ju is Managing Director and the CIO at NF Trinity, joining us from our studios in Hong Kong here on the Daybreak Asia podcast. Welcome back to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. So now we want to examine how Wall Street is reacting to President-elect Trump's choice of Scott Bessent as Treasury Secretary. Joining us now is Ross Mayfield. He's investment strategist at Baird Private Wealth Management. He's on the line from Louisville, Kentucky. Ross, thanks for making time to chat with us. Give me your impression of what you're expecting from Bessent. I mean, the way in which markets responded today was quite bullish.
Yeah, I think that there's a real expectation baked into the move today that Bessent will limit some of the worst or more anti-growth tendencies on the tariff front. I know he said priority number one is the tax bill. I think almost everyone on the street expected that Tax Cut and Jobs Act would get extended in some way, shape, or form. So the big thing is, can we be a little more strategic with the tariffs and a little less blanket some of the threats during the campaigning where obviously, had Wall Street on edge. So I think the idea that Bessent could tamp down those worst impulses is alluring to Wall Street, but I would also say that you can probably expect continued volatility there. And if we remember how much turnover there was the first Trump administration, I wouldn't be surprised to see a lot of changes across the 4 years.
So I just want to be clear, volatility in the equity market as well as the bond market, because yields were down pretty dramatically today, right across the curve.
Yeah, I get it. I think Bessent is saying all the right things about wanting to bring the deficit back in line and attack the national debt. I think that irregardless of who had inherited this economy, we're in a good place. But the challenge of continuing to grow the economy, extend the tax cuts, and attack the deficit all at the same time is a very tricky triumvirate of things. And so the bond market likes the commentary on the deficit, I think. But we'll see if it can be delivered upon because there's a lot of competing forces that'll have to be dealt with.
So how do you think this will impact the way that the Fed has been thinking? I mean, Powell has got, 18 months left in his term at the very least. Do you think that the Fed is going to be a little bit more constrained now to be accommodative, given the fact that there's just a big question mark about where inflation goes from here?
Yeah, I think obviously, the policy proposals maybe widen the bands around your inflation expectation. But I also think that, Powell and the Fed have been very vocal about wanting to be independent, about how they don't really think about the politics on the Hill. I think that they will want to continue on the path that they had preset out until the data that they look at changes. And I think that over the last couple of years, they've probably been a bit humbled in their ability to forecast inflation. And certainly with policies like the tariffs that have been proposed that we really haven't seen in close to 100 years. So I think they'll continue with gradual cuts. And I think they'll watch the job market closely. If we get another kind of weak non-farm payrolls report for November, I think you can pencil in a December cut, and I think they'll probably still have 4 or 5 on the table for 2025. I don't think, as much as he's pushed back against President Trump at times, I don't think he'll want to go too far in the other way either.
So when you look at the equity market, one of the things that really jumps right out at you is the rally that we had in small caps today. I mean, yes, they are more exposed to the domestic economy. The Russell 2000 hit an all-time high today. Is this still a trade that has legs, or maybe that trade has already been played out? How do you read it?
I do think it's a trade that could still have legs, at least in the near term. There's a lot of animal spirits in the market. Some parts of the Trump trade continue to rally. Certainly you're seeing it in crypto, small caps, financials, and banks. But it's one that I'm not inclined to chase, really. I think that in a higher for longer rate environment, small caps are just they just are starting behind the bell. They're more indebted. They have more floating rate debt. we've seen even as the Fed has been cutting. Now, obviously, we get a big move down in 10-year yield today, but since the Fed made their first cut in September, the 10-year has been straight up and to the right. That's just a huge headwind for small caps in an environment where the domestic economy is doing well, better than most expected at this point, but is certainly slowing or has its fair share of challenges. So I would want to still favor large over small, and especially if the new administration kind of takes some of that regulatory burden off of the big tech stocks that we've seen lately.
Yeah, fewer regulations, definitely. Let's talk a little bit about energy policy, because this is another area where the president-elect and his incoming Treasury Secretary seem to be on the same page, pumping a lot more crude oil. Are you playing energy at all in any way?
It's a question that we get a lot. And the thing that I just remind folks is while the drill baby drill policy is good for consumers in the sense that it has the potential to drive gas prices down, it wasn't necessarily a winner for the energy stocks in Trump's first term, even before the COVID-19 pandemic, which absolutely, obliterated the energy stocks. The energy sector was roughly flat in Trump's first 3 years. So there's a real difference between easing regulatory burden and making it a good environment for drilling and putting holes into the ground, and for investor return. I think they're two different things, and I would be hesitant to chase energy here. Because I think we've seen this story play out once before in 2016, and it didn't necessarily end well for those who went all in on energy.
I was talking a moment ago about President-elect Trump saying that he will impose some new tariffs, additional tariffs on Chinese goods of about 10%. This would be in addition to the existing levies that are already in place. On Truth Social tonight, he was saying that this is basically due to the influx of illegal drugs into the U.S. from China. And then separately, he was talking about imposing a 25% tariff on all goods from Canada and Mexico. When you hear language like that, yes, maybe we're early innings here, and maybe the incoming Treasury Secretary will modulate the way in which these tariffs are implemented. But nonetheless, does it keep you a little cautious on putting money to work offshore?
Yeah, I think it should. Or at a minimum, it's going to make the dispersion amongst winners and losers quite a bit more wide. I mean, you look at Mexico and Canada, and to me, that's negotiating for the next USMCA. He's talked about a tariff on Europe. To me, that's negotiation as well. The China stuff I would take seriously, though, because it is the one path that he pursued vigorously in his first term. It's fairly bipartisan, whereas the other ones might not be as much. So I would take the China tariff threat seriously. I would hope that, again, it starts this negotiating, and maybe Bessent can tamp down the worst impulses there. But I take it very seriously. And to the extent to which you look at international equities that might outperform, I think you have to start to look at what areas might do well if the U.S. continues to decouple from China, places like India, places like Vietnam. If not for this USMCA, somewhere like Mexico, where we can nearshore a lot of manufacturing and have a better trade relationship. So there are going to be big winners and big losers. I take the China tariffs a lot more seriously than the other two at this point.
One question, Ross, before I let you go, and it has to do with Bitcoin. And I understand that a lot of this trade is due to the notion that the president-elect is going to be a lot more crypto-friendly. Is there something else going on here in this trade? Do you trust it? Are you participating in it?
The thing that always is going on in a crypto and Bitcoin trade that doesn't really exist anywhere else in the market is just the fervent belief of its supporters. You just don't really have the kind of animal spirits and enthusiasm in any other corner of the market, except for maybe in the meme stock craze we saw a couple of years ago. So when there's good news, there's really, it's just get out of the way. I'm not necessarily the biggest believer. I think the actual mechanisms by which a new administration could be this good for this cryptocurrency are a little loose. A couple of the promises that have been made kind of just offhand in different speaking events. So it'll be interesting to see. Obviously, the deregulatory nature broadly of the administration should help, not just cryptocurrencies and Bitcoin, but the financials and banks writ large. And we're seeing that in the stocks. But same with small caps, I wouldn't chase. I think there's a lot of FOMO and enthusiasm, but maybe the fundamentals are a little lacking.
Ross Mayfield there. He is investment strategist at Baird Private Wealth Management. We go next to Tom Bruce, macro investment strategist at Tanglewood Total Wealth Management. He joins from Houston. Tom, we've been speaking about the market's reaction to the nomination of Scott Bessent as Treasury Secretary. I'm curious to get your assessment.
I would certainly agree. And thank you so much for having me on. As a macro investment strategist myself, I couldn't be more thrilled to have a global macro person as the Treasury Secretary. So, I think markets were very excited about it. And you see, the biggest move I saw was the 10-year coming down, which had a wide range of effects across all the markets. Yeah. And I really feel like the main drivers of the 10-year were, we're most likely not going to have a type of tariff regime that's going to lift inflation too much. And B, with Bessent, it's unlikely we're going to have as bad of fiscal deficit that a lot of people were concerned about. So I think both of those help move interest rates lower a bit.
It's very interesting that you make that point, because he did give an interview to the Wall Street Journal, and one of the points that he made is that he will fulfill the president-elect's pledge when it comes to tax cuts. Indeed, that will be one of his priorities. So how do you balance tax cuts with the idea that you're not going to expand the deficit? Seems to me that spending has got to come down in a big way.
Oh, you're right. It depends how much spending really needs to come down to, because if we don't spend more than nominal GDP, we're okay with the debt to GDP ratio. So we can be okay in that sense. But with tax cuts, it could add some potential pressure there. I don't feel like tariffs are going to make up for it much. I think Bessent overall was the more moderate choice for tariffs. So if he has influence in that capacity, we'll probably not generate much revenue from that. So it is a little bit of a concern as far as how that factors into the overall deficit. But I have some faith that the Department of Governmental Efficiency will help with that. And as a whole, it's just not a major concern of ours.
You were talking about the price action in the bond market a moment ago. Yeah, I think the 10-year lost about 13 basis points today, last quoted in New York at around 427. Is it fair to say that the next big catalyst for markets will be the Fed meeting in December?
Well, yes. Yes and no. Short answer, yes. Long answer is we have a good bit of data in between. We have CPI, we have the jobs report. Now, their main relevance would be towards what the Fed's going to do. So it is a question of what the Fed's next move is. And as you know, with the odds, it's about a 50-50 chance right now. I'm still penciling in a rate cut in December. I think Powell pivoted a little bit 2 weeks ago, saying the pace of cuts are going to slow. I think we still get a cut in December, then move to a quarterly rate cut basis after that. So looking at December, probably March, and June is too far out to really have an educated guess on that one. We may get another cut then, we may not. Maybe the terminal rate's just 50 basis point lower.
Our colleagues were speaking earlier with Neil Kashkari, the head of the Minneapolis Fed, and he was saying, hey, it's within reason to consider a rate cut. But to the point that you just raised now in terms of 2025 and the suggestions that the Fed has already made in terms of maybe modulating the pace of easing, what are you seeing in the overall economy that would argue for maybe holding rates steady right now? I mean, I'm thinking of the labor market in particular.
My default assumption would be the neutral rate's a bit lower, meaning we need to cut a little bit more from where we're at. But it turns out the U.S. economy is not as interest rate sensitive as previously believed, and I think it's sort of a story of two different consumers. You have the lower end that's really struggled, and they're very interest rate sensitive. They're trying to buy a home, and the mortgage rates where they're at, it's really tough for them. And if they're renting, rents have gone up tremendously in the last few years. But the higher income consumer tends to have a lot of assets. They own their own home, so their shelter costs have not gone up as much. And if you couple that with owning real estate and owning assets, you have a tremendous impact from the wealth effect overall in the economy.
Are you favoring the American market over opportunities offshore?
We still are. There's certainly opportunities offshore. If you look at Europe, what the rate cuts are having there is certainly some cyclical opportunities. But as a whole, we still favor the U.S. because, the regulatory structure there is just not as competitive. I believe over the past 15 years, the U.S. has gone from the same size as the European Union in terms of GDP to being about 50% more now. So it's just a huge change over the long term, where the U.S. has benefited from a better regulatory environment, from being the leader in tech, much higher productivity, and we can have rate cuts in Europe, and that'll help short term, but over the long term, they really need to make some structural reforms. Now, looking at Asia, I think what China is, first, well, we don't invest in China because we don't invest in autocracies. But if you look at what China's done from a policy standpoint, a lot of it, I think, is correct. It may not go quite far enough, but the general recipe that they've enacted there, I think, has a reasonable probability of success. I believe some of Southeast Asia is interesting as well. We expect China to get hit by tariffs to some degree. Maybe not Southeast Asia, we'll see. But with less goods coming from China to the United States, we may see lower prices for other countries that import from China. And Southeast Asia has a significant portion of their imports come from China. So you may have a tailwind come from that, where they wind up having a greater degree of disinflation than most people expect.
Tom Bruce is macro investment strategist at Tanglewood Total Wealth Management, joining from Houston here on the Daybreak Asia podcast. Thanks, Tom. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.